Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day once, Liam Garman, Managing Editor of Real Estate here at Momentum Media, the team that brings you the Smart Property Investment Show. And I'm joined by someone who needs no introduction because the Daily Mail did it all. Sam Gordon from Australian Property Scout. How are you going? Welcome back.
Liam, very, very well, man. Very well. Good to be back, man. And good to be sitting here with you, man. I love the energy, mate. You're a new little take on it. On SPI, mate. I'm loving it.
Well, do you ever get stopped in the street from your other coverage?
Not too much. Like occasionally, man. Like you'll get people come up sort of at the gym or a cafe or at the airport. It's very occasional. You know what I mean? It's not heaps, but yeah, man. It happens here and there. I've been obviously from the property side of things, mate. I've been in the spotlight for 6-7 years now. So it happens a little bit here and there, mate. But I'm definitely don't see myself as a celebrity.
Well, you know, and I'm going to ask the hard questions. Okay. And I actually said before the podcast that, is there anything off topic? But then, that all goes out the window the second we start recording. I literally forgot what I was about to say now. 108 properties is what you said you had. Is that kind of guerrilla marketing when you go out and you get those major headlines and then everyone in Australia, I think there was that point, there was a few weeks there where you probably had like a couple of million people read stories that you were featured in.
Yeah, it was crazy.
Is that the world of guerrilla marketing according to Sam?
Bro, you know what's really funny? There was actually no plan to do that. So it was literally one of my assistants was walking around just doing it. And I was at the end of it. I didn't even know because I was sitting right out in the back of the boat. It was a Christmas party with the APS team, right? And she had it planned, but I didn't even know it was part of a plan. She was going around just filming everyone because we are literally a company full of property investors from the admin. Yeah, literally like the post said, I think it was like from the admin to the top raw property investors. So, mate, it wasn't intentional. But yeah, man, it certainly took off, that's for sure. And there was a lot of heat around it.
Yeah, and this is something that we were talking about last time, which is, building a team of people around you that want you to succeed,
100%.
Want you to thrive.
Yeah.
And it would fill your clients with a lot of confidence that you're going to people that work for you and with you, and they're buying into this philosophy, and they're buying into the methodology that you have to scale your portfolio. For people that might now only be joining us on this journey that might not know the philosophy according to Sam Gordon, can you give us a little bit of a snapshot?
From the investing philosophy or the business?
Well, the investing philosophy.
Yeah, sure, man. I mean, so for us, mate, like we're all about building wealth through property, but from an affordable perspective. You know what I mean? Like I don't believe someone should be holding property and absolutely bleeding during that time frame. I think there's a very intelligent way of doing it and being strategic within your portfolio and not bleeding the whole way through while you're doing it. Man, I learned that very much in my 20s, where I did bleed a lot during my portfolio, tried a lot of different strategies, and effectively just formulated, pretty much a pretty clear outline on what worked really, really well. And yeah, man, just kind of kept rolling it out, kept rinsing, repeating it. And mate, by the time I was 28 or 29, I think I had a 20 property portfolio making less than the average Australian income. So effectively, like for want of a better description, like crack the code on how to scale a portfolio in Australian property. And man, we pretty much just roll that out, the same thing to our clients. And I think the really cool thing from a philosophy perspective within the business as well, man, like 80% of our team were hired from being clients first. So they were clients first. Yeah, man. Yeah. All our strategists are clients that I strategized their portfolios and got them into the top 1% of property investors in Australia. Like I think the strategist that's got the least, I think he's on 6 or 7 now, and all the others are 10 plus property portfolio. One of them's 20 plus property portfolio. Like they're the strategists that are obviously within the business working under myself as well. Yeah, man, they understand it. They get it. Like all the client success girls, they all have it. All the BAs that are within there as well, man. They've all got sizable portfolios and a building from there. And mate, we all love it and live and breathe it. We don't really look at it like, while it is obviously a business, like we just see it as the vehicle. You know what I mean? It's the vehicle to create wealth, and we're all in on the journey together. And then obviously with our clients as well.
Which is and before the podcast started recording, before we hit go, you and I were talking about that philosophy, which is you're here to take people on that holistic journey to build out their 10, 20 property portfolio. I'm sure you're there to help the person that just wants to buy the one, but that's not what you're focused on. You want to build that wealth, which is why you've got the what is it, the 500 retirees?
Yeah, retiring 500 people by 2030.
By 2030, which is massive.
It is, man. And I think like the last few years, obviously we've been scaling people's portfolios so hard. What we realized, and so many people want in on that piece as well. And I think what we realized, man, was like, I don't want to sign on. And this is, I think, where a lot of people go wrong and like smash the ads, and then they just get one client, and that, let's say they sign on 100 clients off an ad spend or whatever. which we don't do. We don't spend money on ads, right? Man, every single day of the week, I would prefer to work with 10 clients and buy them 10 properties than 100 clients with one each. Yep. Not only, obviously, is it more of a headache to work with 100 clients than 10, but you get so much more out of it. And like, man, I literally get like emotionally attached to my clients and their portfolios and what we're building. And I know all the other strategists do as well, and the clients do too, because they've been in those shoes too. So yeah, man, it's quite honestly, mate, we don't like signing people on. We typically don't sign someone on if they're like, oh, I'm just coming, like doing one deal. I've worked with 4 different BAs and done 4 different deals with 4 different BAs. We're like, man, like, or when, like, we understand, like, it's all good. We're not the right BA for you, because like we like people that want to come through and build the whole portfolio. Because this is the thing, man. It's like, it's one of those things. Very much a transaction, but like so much of what we do is a strategy piece as well to ensure people can keep moving forward and building that portfolio. And I think when they build it like that, man, and treat the portfolio like a business and build it properly, that's what we get excited by. I don't get excited buying someone one property. Do I get excited by like a 24-year-old chick making less than the average Australian income getting to 5 properties by 24? Like one of Ella Woolcott, man, did her portfolios 5-6 months ago. 100%, man. Like taking kids in their 20s, and regardless of age, like people in their 50s that have never bought property before, and building them a 3-property portfolio in 12, 15, 18 months. Like, that's what juices me up. Not just 100 single transactions. Like, that to me is just a headache, man. I'm not in business to still do that. I'm in business to scale those people that really want to achieve financial freedom. This is how I know how to do it, and it's not just a singular purchase. It's literally building a portfolio, man.
And that's the confidence that your clients have in you as well, because there would be, we both know, right? There are so many BAs out there, especially in the last couple of years, where you do your online courses, and then suddenly you're a BA overnight, that are just churning and burning through clients. And in their world, because their client service is so bad and the quality of product that they deliver their client is so bad, they're happy to not see the same guy twice, right? But the fact is, you back in the properties that you're giving your clients so much that you want them again and again and again. You got so much faith in the product that you're giving your client that okay, cool, I'm going to see you again in 6 months to a year, because I know the property that I just referred you is going to build up in equity 100%. Super quick. So I know you're going to be back. Now we haven't even got onto the theme of the podcast today, because it's a pretty cool theme. It's treating your portfolio like a business.
Can I even say one quick thing on that with what you said before? Man, I think there's a lot of people trying to get into the industry with the right intentions. I think the biggest issue, man, is even if you have the right intentions, or you've gone and bought yourself 1 or 2 properties, or a BA's bought you 1 or 2 properties or whatever, and you're trying to do the right thing, the biggest issue that I see with a lot of these guys coming out is they don't actually have the experience themselves. And when you don't have that experience yourself, man, you haven't gone through the process, for one, of building a portfolio of your own and scaling it to a decent point, you can't show someone else how to do it. And if you haven't bought a large number of properties and negotiated in so many different markets and finesse the ability of building agent relationships, you can't get access to the correct deals. Not only that, is you won't know how to value a deal properly.
100%.
So you may think something's a great deal, but you might just not understand it. And this is where we see a lot of these guys falling over. They think they're doing a good deal, but completely misunderstanding the pocket within the greater suburb. And they may be paying 20 grand over when they think they're buying 20 grand under, but because the pocket's so bad or inferior in that suburb compared to where they're maybe valuing it against, it's not comparable. So, man, I think like a lot of these guys are like going out trying to do it with the right intentions, but unfortunately, without that experience and actual ability around it, and it is an extremely hard market to buy in right now. Like, we do over 90% every month of off markets, but if you don't know how to do that, how to access it, how to build those relationships from that perspective as well, I mean, you can't do it on repeat, and you can't effectively guarantee those quality of results even from a valuation perspective as well. So yeah, man, I feel it's hard, because I don't want to like shit can all the new guys coming in, but you just see them not doing a great job because they just don't have that understanding. Even however good the intentions are, that doesn't correlate to being great at execution just because you have good intentions.
And that you're probably more diplomatic than I was, because I was going to go into shit can. But I mean your point.
I know where you're coming from with it. It's just like I see the picture. You know what I mean? Like I know what's going on. You just see it so much. So
everyone starts somewhere. But like your point about the comparable pockets in an area, and I think the probably the best example is Brisbane, where within the same street you got up and down a hill. One part of the hill gets absolutely flooded, and the upper part's fine. One part of the hill's uninsurable, and we're talking houses that might be 3 or 4 houses apart. Unless you have that local knowledge, you simply don't know. Now I might be asking, it might be a bit of a challenging question. Are those gains still there that we saw last year, the year before? Are those gains still accessible for people?
Depends on what sort of gains we're talking about. So the one caveat I'm going to throw on like gains compared to last year, we saw Perth in a lot of areas like 40 to 50% in like an 8 or 9 month window, right? The start of the year or like even call it from December through to like August, September, that spurt, like I won't say I've never witnessed anything like that, because Brisbane in like end of 2020 to like mid 2021, late 2021, late 2020 to early 2022, that 18-month window, like some of my properties are like 80% in 18 months. Like it was crazy. Perth did that again last year. So if you take the anomaly of like 40 to 50% markets out of the equation, and even still, man, there will be some markets that will produce that in the years to come. It's just like, it's got to be drilled down. Everyone can't look at it from like a whole national perspective in terms of where it's going to produce. It's different markets will produce different amounts. Mate, 100% there'll be markets this year that do 30% worth of growth. Man, without an absolute doubt, there'll be markets at the end of this year that do 30% worth of growth when we come into January next year and we see that data. And then there's going to be other markets that go backwards, other markets that stagnate, and other markets that do 5, 10, 20% and sort of might be starting their cycles as well. So, man, it's really important to sort of understand what you're trying to get out of a property, get out of the portfolio, and effectively always like, what do you need next in the portfolio as well, to make the call. But to answer your question, man, like, yeah, there's definitely going to be some standout performers this year. And I think it's going to be really interesting to see which ones they are. And I've got my internal bets with the team as to where they are. But yeah, man, there's definitely some movers and shakers out there for this year.
Yeah, there was sure. On that note, we've actually got to get to the theme of today's podcast, which is treating your portfolio like a business. But I do have one more thing that I want to say. When we come into these podcasts, we're like, well, let's just riff it, and then we end up talking half the time. But no, it is good. It's good, valuable content. I'll give a plug to your APS podcast now, because I was actually listening to one of the
Scouting Australia.
Scouting Australia. I was listening to one of the recordings that you did, and it was about why you should be partnering with a BA. I think it was yourself or Jimmy that was talking about it was about, like, if you're a regular Aussie, you might do a negotiation once, twice, maybe 3 times in your entire life, versus a BA who's doing it 200 times a year.
Yeah.
If you go up against an experienced real estate agent, you're gonna get burnt. And the example that you guys were giving of just like the incremental push-ups, I did that with my owner occupier, where they were like, mate, if you just an extra 10K today and we're signed, we're in. And me and my wife were like, oh wow, 10K, like let's just do it, let's just get on the other side of it. And I was listening to your podcast where you shared those little insights. I'm like, oh man, but that's kind of like, when you factor in things like BA fees and all the work that you do for your clients to streamline the buying process, plus the benefit that you get not having the mess around with the real estate agent negotiations where they're trying to push you up an extra 10K, but you actually might be getting it off market for 10K cheaper. You make your BA fees back. But anyway, that's my plug. Go and listen to the Scouting Australia podcast.
I appreciate it, man. I appreciate it, brother. Thank you so much.
Now, treating your portfolio like a business.
Yes.
Reminds me of our last podcast that we had together at the end of last year. And one of the big questions that I asked you was, because, I speak to a lot of people on this podcast, and there's a very big difference between schools of thought, I guess. Your school of thought is, I think the wording that you used was treat it like a sports team. If you've got an underperforming player, sub them in and out, get a better performing player. Some people are like, no, I will never sell anything ever.
Enjoy working.
Talk to me what your philosophy is by treating your portfolio like a business.
Well, literally, I'll go back on that, something which you said just there, right? Like, I'll never sell. And the reason I say enjoy working is because, man, so often people will have that mentality just because they've seen property rise for so long and all the rest of it, but they don't look at the peak and troughs, right? If you look at an actual graph of Australia over the last 30 years, man, most markets will plateau for 10 to 15 years and do nothing. And then they'll seriously grow and have massive cycles over a 3, 4, 5 year window. If you then sit and it does nothing for another 10 to 15 years, what is the point of still holding that property? It's had massive growth. If you've been able to keep building your portfolio, it means you had to take equity out of it, increasing the cost base to hold it, and then go and put that somewhere else. So you're holding on to something that's performed for you, it's given you the result you wanted and had that massive growth, but now it's low yielding for what it is. Like, isn't the name of the game to get to a passive income goal? Passive income goals aren't achieved by holding growth properties, especially once they've done their job. So, mate, I always look at it, whether it's a sporting team or literally like a business, or if you were literally a business and you were selling a product and you didn't make money out of it for 10, 15 years, or it was losing you money, would you keep selling that product? If you had an employee, and this may sound brutal to some people, but it's dead honest, right? If you had an employee and they were unbelievable for 3 to 4 years and absolutely shot the lights out, but then something material changed in their life, and then all of a sudden they cost you money every year for 10 years, you're not going to hold them in the business. Sporting team, like someone absolutely amazing and they may be amazing for 10, 15 years of their life, but then they hit 35, and almost all athletes at 35, they're either retired already or they're on the way out. You know, they're playing for money at that point a lot of the time, just to get a bit of extra cash at the end. I mean, you're not holding that player you know what I mean? Like at the absolute top tier of sporting. Man, they get put out to pasture, they get moved on. And I think people have to you have to look at it from that perspective. Something is going to perform for you for a finite period of time. The growth rates don't continue forever. And if you hold it for let's say 10 years in the doldrums doing nothing, if it's costing you 10 grand a year, 15 grand a year, just remember, you have to make 100 to 150 grand's worth of growth just to break even on it again. Just from cash flow, let alone inflation eating away the profit and opportunity cost.
Oh, with that, so yeah, like that 15 grand a year over 10 years, 150K, like that's
grand.
the bare minimum.
Bro, bare minimum. You know what I mean? And like, what if you've equity extracted the hell out of it, and so it's costing you even more to hold? It could be like, especially a lot of these blue chip properties, people say hold forever. It's like, man, well, what's the game plan? If it's costing you 30 grand a year for 10 years, it needs to grow by 300 grand just to break it, just to start making money again. Yeah. And so for me, it just doesn't make sense. And if it has significant growth and it's finished its cycle and it's not going to perform again for a while, man, cash in the chips. You don't stay at the casino for another 10 days just because you've had a win. Like, you know what I mean? Like,
I know some people that do, but
you might. But you know what I mean? Like cash it in, bank the profit, clear the debt. Yep. It's done what it was in the portfolio to do, and then either build on it somewhere else or use those profits to consolidate debt, consolidate those high, net returning properties as well. So, man, I feel like it's probably and it's funny because that's literally exit strategy, right? So that's almost all exit strategies is focusing on what you're going to do with the property at the back end of it.
That's kind of the end of the
100%. But it's so important, man. And like sometimes beginning with the end in mind is so crucial. And if we kind of kick off what we're talking about here, being really clear with your goal setting and then creating a game plan towards how you're actually going to do it, man, that's what it's all about. So if we talk philosophies, man, like I am definitely not a buy and hold forever guy at all, and never will be. And don't believe in it. I don't believe it's a strategy, man. I don't believe it's a strategy.
It's just foolish.
It's not going to get you to your goals.
Yeah.
Because unless the goals are to sit really like net equity rich for life, and you can't eat equity, man. You know what I mean? Like, and the idea of like releasing equity and living off that is ridiculous because like it's eventually going to catch up with you.
It's finite. Yeah.
Man, like, you know what I mean? Like, how dangerous is it?
Yeah.
Like, for one.
Well, we're talking game plan here, having goals in mind, and one thing that you said before, which is that end goal. I think this is the most final part of that goal is passive income.
Yeah.
So you would say when you're sitting down with the APS crew, you go and how does it work? Like you come up with a passive income in mind. What's the goal setting look like?
So we'll always come down to someone's individual goals. So let's say someone's chasing $200,000 a year, right? You reverse engineer the strategy of 200 grand a year effectively with cash flow properties. So you'll bring that into the mix first. Okay, how many cash flow deals, how many high net yielding assets do you need in the portfolio to hit that goal? And that
what would they look like? Like blocks of units or what?
It depends, man. So in the current market, mate, like residential cash flow is pretty close to being dead. There's a little bit of it around, but not that much. So the last few years, we're able to get really, really good returns, or really up until pretty much the last 6 to 12 months. Tape it off. Now, commercial is definitely the pick from that perspective. So yeah, man, like previously it was house and grannies, unit blocks, duplexes, all those sorts of things, man. You can do value adds, you can renovate them, build it, all the rest of the sort of stuff. Now, man, because the yield compression has been so strong, it's definitely the commercial play that gives you the best route. And again, man, depending on the individual and their specific game plan, if they're a lower income earner, they may have more properties in the kitty that get them to the 200,000, like in the portfolio on the back end, more lower price properties. And then if there's someone with a bigger income, bigger portfolio, bigger starting capital, all the rest of the sort of thing, it may be fewer at a higher amount. So it's just really reverse engineering that, man. And like how many properties do you need in the portfolio for that? And then, okay, how many properties do we need in there from a growth perspective to be able to build up that equity base and then obviously consolidate down the equity base in time to debt reduce those as well.
Now, it seems there's always going to be hurdles in the way. You make it seem so easy, but you've got considerations, tax, etc.
Yep.
How do you factor this into the strategy?
Yeah, for sure, man. So like tax is a very important one if there's a disparity between incomes in a household, or if it's just you yourself. You still need to be intelligent with it. But man, pretty much the planning, and this is a conversation for your accountant. Like, and you want a property specific accountant that understands this really well, not just Jeff down on the corner at the shops. You want someone that's a property specific accountant that can literally help you plan this thing out. Because a really good property accountant will also be able to help you plan in terms of how to build it out as well. Yeah. So property specific accountant and broker will help you be able to build it out properly. And let's say a strategist or a BA or something like that that's done it as well. But then, yeah, man, you factor in that tax planning. And some of your exits, like some of the exits that I've worked on with clients as well is, someone will be coming up to have children, and they may earn the same money, like a husband and wife may earn the same money, but we can see obviously planning's coming in for a child to come in, and this all comes in part of the strategy of sort of timeframes as to when we're thinking of as well. And man, if that lady's going to drop off from an income perspective, have a baby, and then maybe they're planning on having another one or falling pregnant again within 12 months, maybe not really going back to work for a 2 to 3 year window, then we might try and time some exits in those financial years with properties in her name, because she's going to be on such a low income, if nothing. Yeah. So she's going to have this huge threshold. Whereas if they were both making 150 to 200 or 100 to 200 combined, each, you're eating up a lot of that taxable amount there. So it's just, man, it's things like that, like planning for like what's coming up, to be strategic with it and maximize things from that perspective. But again, man, really good tax accountant, property accountant specific with that, and then good planning with it with a good strategist as well.
Which is why you partner with people in the know, because I would never even thought of that.
Yeah,
I would never even thought of that.
Man, there's so many strategies around that side of things, and people coming in and out of work that you can really take advantage of from that perspective as well. Yeah, man, and a lot of vehicles to really maximize it from that perspective too. Man, there's so much goes into planning and being strategic, because to me, man, $1 saved is $1 made. And like people kind of laugh at accounting's boring, but dude, tax is sexy, man. Like if you build a 20 property portfolio and you're strategic with it, you'll probably save yourself $1 million. $1 million is sexy, right?
That's sexy.
If you're saving it via intelligent, tax strategies and stuff, man. Dude, that's sexy, man. I love that.
Yeah. Now we're having a chat before, and you made a note about you wouldn't drive to Perth. What do you mean by that?
Man, so when you build a strategy, it's effectively a map, right? Like it's a game plan. And obviously there's always variables. It's like if you were driving to Perth, mate. I guarantee you drive from Sydney to Perth right now, there's going to be a couple of roadworks and a couple of detours along that route, right? Yeah. So there's always got to be a little bit of being malleable to situations changing. But realistically, man, if you're driving, a huge distance, you're putting on Google Maps or Apple Maps or whatever it is, and you're being shown the pathway to get there. You're not winging it. You're not using a UBD anymore or anything like that. You know what I mean?
What's a UBD?
Oh God, are we that much difference in age? The old maps that you used to open up,
like
in the books.
Yeah. Okay. Man, like you go in the back, like A47.
They used to be. They used to be in the servos.
Yeah,
man, you know what I mean? Like you're not opening one of those, mate. You're throwing on Google Maps, and it's giving you feedback as you're making that trip as well. So, man, portfolio planning should be no different. Mapped out at the start, and then obviously planned, being malleable moving forward and being liquid. If things change, man, you got to change with it. And yeah, bro, like building a portfolio like that way too.
Now, risk tolerance obviously plays a really big role in this, and in particular where people might be trying to set up wealth for the future. I think it's very reasonable that a lot of people nowadays, a lot of young Australians especially, would look at APS and the product that you offer and your philosophy and say, this is a great way for me to make my money work for me. I'm saving a bunch. I live in Sydney. Really, there's no point paying like 1.5 mil for an apartment or a unit and then shackle myself to debt for 30 years. Are there more intelligent ways that I could be spending my money? But risk tolerance is a major factor in this. People simply might not know about property investing. How do you negotiate this? Yeah, man. So probably the biggest thing to take into account when it comes to people's appetite for risk and risk tolerance around it as well. If we look at appetite for risk, it's the most simple thing. What I always ask is, what would it feel like to you to, like, how aggressive does it feel to you if I was to say you would buy 2 properties this year?
They go, oh, no, that sounds. Like, what would you think?
Well, I know you. So, I mean,
you know what I mean? You're sitting across from someone and you ask that question. You go,
Yeah.
all right, 2 properties a year. No, I feel good. Okay. What about 4 properties a year? Or it's starting to get a bit hectic.
Yeah, it's a bit more. Yeah,
but then you might say 10 properties and be like, man, whatever I can do, however I can get there, I'll do whatever you tell me to do.
Yeah.
Okay, sweet. There's a different risk tolerance and appetite between someone that says that to you, and then when you start going from 2 to 4, they're like, oh,
yeah, it's a big jump. That's a jump.
And risk tolerance changes as well. And a lot of the time, it's based on results. So you have a great year or 2 years in property, and I've had this with heaps of clients. They start with 1, 2 deals in the first year. Second year, they definitely do 2 or maybe 3, and they get to year 3 and they go, man, can we get to 4 or 5 properties this year? And so it can definitely change, but I think so much of a game plan and a strategy, and again, in business, man, different people in business have different appetites for risk. You know, some people may want to go, okay, sweet, we've got 100 grand, or we've got 10 grand or 20 grand or 100 grand left over at the end of the month. Let's smash that all into ad spend, or let's go higher somewhere else, or whatever else. And that's someone aggressive in their approach. And then you have someone else that goes, oh, well, let's leave that in the kitty and let's save that for a rainy day. And man, this is why, like, when you're looking at it, you've got to assess that appetite for risk and how hard do you want to push? How easy do you want to go? All these sorts of things. My recommendation is always, if you're able to do 2 properties a year, man, always acquire 2 properties a year as a minimum if you can do it, because in 5 years you've got a 10 property portfolio, and if you built it in the correct way, by the time you're getting to years 4 and 5, you bought in the right market. You should be exiting a couple of those deals, setting you up for the next phase as well. So that's me, man, as a sort of minimum that I think most people are kind of happy to work with that. But dude, it's all about assessing how you actually feel when you start out, and different people have that different appetite, and you just have to be clear with it. Because if you go, yeah, I'd love to do 10 a year, but then you get scared doing 1, you've got to legitimately weigh it in until you got the confidence, and then obviously start rolling it from there.
You have to readjust your expectations. Now, a lot of people that are sophisticated investors, I guess, the idea of 2 a year might not be shocking for them, but for people that are tuning into this podcast maybe for the first time, and I think it's always good to go back to this as a basis. Actually, and to be honest, I reckon there's a lot of sophisticated investors out there, like quote unquote, that might not really understand the debt game of it, might not really understand the overall macro strategies of it. If you're, say, a couple on an average income, how do you actually get to 2 in a year?
How do you get to 2 in a year? And you're starting with 1 deposit?
Yeah. Let's start with 1 deposit.
Yeah. So, mate, you're buying and it depends on your risk profile again. So if we go back to that, and again, like, what's your risk tolerance on deals? Do you want something you're doing work on, or you want something clean? Because again, that's a tolerance in itself. Do you want renovators? Do you want full shitters that you're going to do a lot of work to? You want a basic cosmetic reno, or do you just want something clean, easy? And most people starting out, I recommend just do a clean, easy deal. Cut your teeth on that for a first deal. Feel the way through the process. Let's buy in the correct location. Let's buy at a discount. And let's see that property grow. And man, a lot of the time, we always recommend to people after 90 days, man. So first 90 days, get that thing valid, see what it comes in at. Typically, the first 90 to 180 days, so your first 3 to 6 months, there's equity in there to pull it out and go again.
Already, so you're there for 6 months, so you.
But man, this is the difference between knowing what you're doing and paying 20 grand over, not knowing what you're doing, buying in the wrong pocket, to buying in the right pocket at the right money and understanding that and paying 20 grand under. There's a 40 grand variance, right? Yeah. But then if you'd been in that correct market, and let's say it was a $500,000 purchase, and then that thing is having a great run and it does 20% growth that year, in a 6-month window, that's 10%. That's another 50 grand.
50K you can pull out.
So if you've got 50 grand plus the 20 you made on the way in, just in that example, there's 70 grand.
Like,
that
like
you can
20
utilize.
off market.
Below market.
Below
discount.
market. Discount. Yeah. So you got 70 that you could potentially pull out immediately. You've put away a couple of K a month, and then you've kind of some deposit number 2 within 6 months. So then in 6 months, maybe you got 80, 90 grand sort of with a combination of everything. Maybe you had 10, 20 grand left over as well. So you're probably sitting somewhere between $80,000 to $100,000 for that second deal at a 6-month window, and you might not have that amount. You may not be able to save that much in that time frame as well. Maybe the val doesn't quite come back. Do it again in another 90 days, at 9 months, 12 months, all that sort of thing. Or if we refer back to that podcast of Ella Woolcott's, it did at 24, man, had 5 properties at 24 years old, 800 grand net equity. Her first year, that first deal didn't val up. We just couldn't get it to val for some reason. And then at 12 months, it valved properly. She got 100 grand out, bought a next deal, and in 90 days, it valved up 100 grand. Oh, you know what I mean? Way.
You know that story? Yeah. So
I remember you mentioning.
Man, but you can never plan exactly for how it's gonna happen. And this is where we can map it as much as we can. And then
that's where your detours on Perth come, because the M4 is under construction or whatever.
Dude, and you got to work it out. You got to work it out. And sometimes, man, like, properties can be a waiting game.
Yeah.
Sometimes it'll come really quick, and you may get the big win on your first deal, and then it may be a bit of a pause on the second, but then sometimes you'll get a win on everyone, and then sometimes it can be a little bit lagged on everyone. It's not an exact science because you've also got a person in there that's valuing that also might be trying to cover their ass and val it low so they've got lower risk. So it's all part of it, man. But it's just all part of the strategy. But you ask about how you can get to 2 properties in your first 12 months, mate.
That makes a lot of sense.
Yeah.
The maths adds up, especially if you know. When you're putting down money for your first deposit, you don't go to zero, right? You should have a little bit of a buffer,
Definitely,
a little bit of a
buffer.
kitty. But I guess one question that I would think, looking at this philosophy, this sequence, I guess, of doing it.
Yeah.
So if you're pulling out, say it goes up from 500 to 600K, and you're pulling out the 100K in equity to buy property number 2.
Yep.
When you get to that point, when you've got like 10 properties, you're going to have to go through a consolidation phase. You start selling them, get in more high yield properties, pay them down, so you've got that passive income.
Yep.
If you've kind of already borrowed a lot of the equity, is there much money left over? That's kind of where the maths that I don't understand.
Man, it's a great question, right? And the biggest thing to understand is when you go from 500 to 600 grand, it's not like you are going from a $500,000 loan to a $600,000 loan. So there's always LVR plays in it as well. So if you bought a 500 grand property at an 80% LVR, that's 400 grand's worth of debt. If you take it up to a $600,000 valuation, that would take it up to 480. So that would be an 80 grand equity release on that front. So it's not full like utilization of complete
because you have to pay
equity every time.
LMI presumably
Well,
if you
on an
start going below.
On an 80% you wouldn't, but it's the ratios, right?
Yeah.
So when you get to the like 20% of a $600,000 deposit, $600,000 property is 120 grand. So that is what makes it the 480.
Yep.
But man, like what we see so many people do, and yes, you might double tap it, right? So you might tap it twice, but a lot of the time to get from the first into the second is just pulling that equity to jump into that. And then you might go from the second into the third off the equity from the second.
Yeah.
And so like, it's not like you're farming every deal to the absolute max every time.
Which would then essentially leave you with no equity left.
Exactly, especially once you pay a little bit of tax.
Yeah.
But man, the idea is to tap it once, maybe tap it twice, and hopefully not really tap it too much after that. But man, if you're early in the piece, this is the other thing to remember. Even if the very first property, you tapped it 3 times to buy number 2, 3, and 4, and then you sold it and cleared no profit.
Then 2, 3, and 4 are going to make you that 50, 100K each.
Exactly. Or
more.
Yeah, that might be per year. But obviously the idea is for it to make a lot more than that as well. So it's all just the planning side of it from there. But yeah, man, that may be literally just your pure equity farm. And I've had that before with clients. I had that myself, man, where like, dude, it might just be your pure equity farm. And like, you look at the examples before, like it may be the one that just keeps popping off and keeps giving you 50, 100 grand every time. Well, if the others aren't giving me that result for whatever reason, maybe it's in a market with valuers that are more conservative. Dude, I'm going to farm that every time to get the other deal. Yep. And then, because the other thing as well, you haven't tapped the others during that process through. So man, but again, it's all about planning of how many bread and butters, how many growth properties you need in the portfolio to consolidate and pay out those on the back end. And it's not normally 1 for 1. A lot of the time it's 2 to 1 because we're accounting for the fact that we are going to be heavily equity farming the portfolio and building it off there. Because you're never going to be able to save deposits as quick as equity can come back to you. Like, 100,000 in a year from one property is very reasonable if you buy it in the right location. But saving 100 grand, like that's a lot of cash.
That's a big question. That's a big ask, and like the simplest maths, and this is what I explain to people because they're like, oh, should I be investing in shares or property at its peak? And the one thing I always say is, property profit's also calculated off of debt. So you might put 50 grand down, 100 grand down for that house, but if that 50K, that 500K house goes up by 10%, that 50K is, you've made money off that debt, right? Which is, if you put
off the
down
deposit, you mean,
off
right?
your
ROI is on the deposit. Well, as
of
cash in.
Yeah, so I mean, as of the entire value of the house, right? As of the entire value of the house, of which a lot of it is debt. Yeah. Whereas if you're, I don't know, putting down 100K for shares and then you get 10% return, it's actually like kind of pretty negligible after tax, right?
But even in the return as it is, man, like 10%, people would think 10% is great. But if you, man, your point's bang on. Man, you're making 100 grand. Sorry, if you're making 10% on a $100,000 investment in shares, it's a direct correlation of what you're putting into it. So it's 10,000. But if you're making the same 10% on that 500 grand asset, which is 50 grand, and you've put the 100,000 in, you're actually up 50% on your cash. Cash on cash returns 50% on that.
What's the technical term for that? Is
cash on cash.
Cash for cash.
Yeah, cash on cash return.
Cash on cash.
So your cash on cash return of the 500 grand asset going to 550, which is the same 10% return as the guy on the shares. Yeah. But his cash on cash is 10% because he's 100 grand cash in.
Cash
10%
on
growth?
cash. Good.
Cash on cash return,
I knew
bro.
someone smarter out there would know the term, because I've been here trying to explain it like an idiot. But anyway, now obviously a lot of this is
great point,
that
man. It's
risk
a great point.
management that we're looking into, because a lot of it is based off of risk tolerance. Risk tolerance is going to inform your objective, your goals. What kind of risk management frameworks do we have at our fingertips?
Man, the biggest one is obviously insurances. So insurances on building, insurances on landlords. So building insurance, obviously covering the building if it was to burn down, or if the cyclone comes through and wipes it out or damages the roof, all these sorts of things. Man, that's why I have building insurance. You know, a lot of people worried about it in tropical Queensland, and we had the storm and that came through in January, I think it was, late Jan into Feb and stuff as well. But man, like, in the last 2 years outside of Perth, or even call it last 12 months outside of Perth, it was the strongest performing market, right?
Yep.
Now, if you'd missed entering Perth at the right time, it was the next best location. But if you weren't going to invest there purely because of a weather event, you would have missed out on a lot of growth in the last 12, 24 months.
100%. Yeah.
So the way to mitigate that, man, is make sure you don't buy in a flood zone, for one.
That's a good one. Yeah.
That's a pretty good one, because then your normally insurance is 7 to 10 grand. But the crazy thing is, man, like, even if you look at areas like Rockhampton, which has nearly doubled in the last 3 years, Townsville, which has a significant cycle, a lot of these sorts of areas, man, as long as you're buying outside of a pocket that's very seriously affected, so properly flood affected, man, your insurances might be like $2 to $4 grand a year, right? Which, man, like, in the scheme of things, if it's the best growth location in Australia at the time, or if it gave, which a lot of those areas last year, man, did 25-30% growth in that time frame, $2 to $4 grand a year, even at the 4. If your average in, say, Sydney or Brisbane is 2 to 3, which a lot of my stuff is, man, you're only $1,000, $2,000 dearer. But I've just made $100 grand per property growth,
100%.
In that time frame as well. So, man, insurances are super, super important. Make sure you got your building. Make sure you got your landlords, because obviously if your house gets absolutely trashed, you want to make sure you're covered from that perspective as well. And then the next best thing, the two most important things, man, insurance, building, landlords. Second thing is property management.
Why property management? Because it
dude,
seems such a routine thing.
Yeah, man, you would be surprised the amount of people that still try and manage a property that's in their own state or in their own city. And dude, like,
They try and manage it themselves.
Yeah.
That's
I
okay.
couldn't even anything worse.
So
man.
this is the second time I've had this conversation over the last 24 hours, because someone said this, I'll just manage it myself. I'm like, bro, it costs you a couple bucks a week. Like,
Man,
it's
nothing.
really? It's
property
like,
management's like $2,000 a year.
Yeah.
It's tax deductible. If you've got a property manager that's on the ball, they're going to be getting you the maximum rents because they're going to be able to negotiate a tenant up.
Yeah.
I'm probably going to get a bit of hate from that. Daily Mail will probably ring me again.
Oh, yeah, there we go again.
But in reality, man, we're in business, right? We're talking about treating your portfolio like a business. And man, like, a good property manager is going to do all those things, but also be the arm's length between you and a tenant and any issues and any bullshit. And for the sake of $2,000. And the other thing as well, they're going to vet them properly to mitigate the risk of any potential problems anyway.
100%.
And if we look at like delegation, man, as well, and like getting everything sent to them, rates, man. The only thing I always cover myself is insurances. I don't like to send them to them and let them auto renew. I reevaluate every year on what the insurances come in at. But man,
just have like more oversight of
100%.
Just,
and if you don't want it to get missed, you know what I mean? Like if it gets missed, like, you know what I mean? So it's that one thing that like I always take care of it.
I suppose property managers are also, a good property manager might be looking, well, good in what way? I mean, there are property managers that are managing hundreds of properties, right? Yes. So it's very easy for something which is super important for you to be missed in the flood.
It's just too important. You know what I mean? Like your council rates, you don't pay those. All right, you get the reminder, you get the follow up, whatever. It's not like if your house burnt down or something bad happened with the tenants, paying your council rates, it's not going to have affected that. Or missing them for a quarter or two or something like that, right? So that wouldn't be the end of the world. What would be the end of the world is if your house burnt down, not the end of the world, but if your house burnt down and the rebuild on it was $300,000, $400,000, $500,000 and you didn't have adequate insurance, that's going to be a pretty bad scenario. Or if your tenants absolutely trash the house, flood it, rip all the walls out, $200,000 fix. Oh yeah, sweet, I'll call Terry Shear. Mate, that thing expired 4 months ago. You never renewed it.
Yeah.
Can you imagine the drop in your stomach if you didn't have that? So
100%.
Mate, that for me is like like we always have it come to us and make sure because then it's on us. But then man, property management, you got obviously your council rates, your water rates, your all that sort of stuff. You just get all that sent to them, man. They take it straight out of the rent. It's one less thing to think about. It's another delegation point. You know what I mean? And to me, it's an absolute no-brainer. Like those two things are complete non-negotiables. Even when I was a super low income earner, they were non-negotiables, man. Your time's more important than that.
Now, a lot of people get super super scared of debt.
Yes.
I know there's a lot of people out there. And I mean, even the example of what the triple tapping, that might frighten some people. Talk us through the debt game. You trademark it. Yeah, get some shirts, triple tapping.
I love it.
Yeah, talk us through that. Like, how do you manage this?
The fear of debt?
The fear of debt.
Man, I think breaking down what is possible by utilizing debt is the most important thing. So, I mean, even if we go back to that example before of double tapping, triple tapping a property, even single tapping it, you know what I mean? Like one property going from 500 to 600 and then being able to pull out that $80,000 worth of equity. If you did that in 6 months, unless you're making like 500 grand a year, you're not saving that amount of money in 6 months. You know what I mean?
Yeah.
Like there's no way you can do it. And, if you're making 100, 200 grand a year, it will take you over a year to save $80,000, like well over. So man, I think people getting the understanding around how important debt is and how much you need to embrace it, right? The banks are your friends in this scenario. When you're property investing, man, the banks are your friends. You want to utilize them as much as you can. You want to embrace it and effectively look to keep building it from there as well. Because, you can't save your way to retirement. You have to, for one, invest, and then in property. If property is the big thing we want to tackle and obviously use as our vehicle, we have to embrace that olive branch or whatever the hell the saying is, where they extend out to you, man. Like that's the most important thing to embrace when it comes to this thing, because leverage is your best friend in this game. The more debt you can get access to, the more properties you can get in great growth locations, the more that your net wealth is going to grow, because you got $2 million out there, which a lot of people may be scared of, like 2 mil, 10 mil, anything, whatever you got out there. But if you got a 10 mil worth of debt, you probably got a 20 mil portfolio. So you're worth 10 mil net. You got $2 million out, you might have a $3 million portfolio. That's amazing. You're worth $1 million net. Like I love that you've got, that you may have, or someone may have that level of debt against the property value.
And this is something that, you got to balance with. I know this is something that we've spoken about, which is that lazy equity.
Yeah.
Equity that's just sitting there doing nothing.
Yeah.
I think that's very prevalent in the Australian mindset, where people have that the pay down the owner occupier first.
Owner occupier was the first thing that came to my mind.
Yeah.
Man, it's a funny thing, because like people are like, oh no, we'll wait till we save, 100 grand to go buy the first property or whatever.
Yeah.
And it's like, but they've got $500,000 sitting in their own home as usable equity. And it's like, but you've just been focusing on paying this thing down for the last, 10, 20 years, 5, 10, 20 years, whatever it's been. You can't save your way to retirement. We'll repeat that again, right? Of what we said before. You pull that $100,000 out now and get into the market just with one deal. You do it as a separate equity release, so you shouldn't really affect the primary loan. Do it as a separate equity release, completely tax deductible, using it purely for the purchase of an investment property, for the deposit and closing costs of an investment property. And effectively, again, use that leverage point to be able to keep scaling and scale that portfolio on the side. Yeah, man, I think it's lazy equity is probably the biggest one that I used to see. So many of our audience now, they listen to the podcast so diligently. Like like Scouting Australia, I've gone through it so many times, and like these sorts of things as well. That people are looking for, like, what can they farm? What can where can I farm some equity out of, pull some equity out of? But yeah, man, anyone that's sort of coming in and they've got that sitting in there, it's like running a case by case scenario. Okay, sweet. Well, if it's going to take you 2 years to save 100 grand to get into a deal, and you're not going to buy anything for 2 years because of that, but you could pull 100 grand out of your primary residence, or 100 grand out of an existing, investment that you've got there as well. What's the velocity of money going to do for you by getting into a great market now, and then maybe in 6-12 months you're buying another one, versus, well, the planning right now is that we're not going to be able to buy anything for 2 years. Yeah. You scale that back and look at it, man. It's an absolute non-compete in terms of what you can do in that same time frame.
Now, I'm going to ask something really personal, but I think it's a really good example of.
Here we go.
I think it is very personal, but I think it's a very good example of putting this into practice. You rent, don't you?
Yeah, man. Yeah.
Yeah, and you're probably, I don't know, one of Australia's biggest property owners, I think would be reasonable to say, and you rent. But it goes to show that you've broken down the maths.
Yeah.
Your dollar relative to the yield that you would be getting is going further on your investment properties than if you bought some mad place on the GC.
Yeah, 100%. Dude, I when we did the summit at the end of last year in Sydney, I did the rent vesting breakdown. I think I did it at like a 750, I think it was 1.25 mil, 2.5 mil, 5 mil, 10 mil. When you're at like 750 to 1.2 mil, it's not like a crazy difference. The difference is still there, and the servicing does increase a lot. It's when you go to, like, especially 2.5, which most people's dream homes aren't less than 2 mil. Like, let's be honest, in today's environment,
No way.
where everyone is, man,
No.
almost no, especially anyone listening to this and wanting wanting to create a better future for themselves, their dream homes aren't under $2 million.
Man,
right?
in Sydney, you know, if you go like places in Auburn, like a semi-livable would still be like 1.8.
Crazy,
you know,
man.
like it's
So buy something nice there, and we're probably talking 3-4 million.
Yeah,
right?
100%.
So
Yeah.
like, if we start throwing that into the equation, and I think this is where the really big needle mover is. You buy a $2.5 million, $3, $4, $5 million primary residence, let alone bloody 10 million. But if you buy anything in that sort of realm, man, the cost to rent it versus owning it is a ridiculous difference, right? Like it's ridiculous. I think at $5 million, it was something like I can't remember the exact numbers because it's gone back 3-4 months ago. It was something like $300,000-$400,000 a year difference in repayments versus renting it. Because and this is, you know, being raw, man. Like the place that we live in on the GC, man, where we're like 3-4 minutes to the beach at Broad Beach. We live on the canals. We've got a view of the city skyline, man. It's a $5 million home. Costs $2,000 a week to rent. It's $100,000 a year to rent it. To own it, man, it would be like $400,000 a year in terms of the rent. Well,
in terms of repayments,
dude, you got a $4 million debt.
Yeah.
If you bought it with 20% deposit, you need $1 million as a deposit to buy it.
Yeah.
You got $4 million worth of debt. At the moment, your interest rates are like 7% on that debt.
Yeah.
And then obviously that would be on P&I because it's your own home.
and that would absolutely tank your serviceability.
Bro, done, man. You're
Yeah.
done.
Yeah.
Like I call the PPR is the anchor, man. It's the
Yeah.
ultimate anchor.
Yeah.
And yeah, to not even dive any further on, like just the correlation on it is just crazy because you need about $1.5 million closing costs with stamp duty, legals, being
Stamp duty would be insane.
Oh, it's crazy, man.
Yeah.
It's crazy, right? But man, even if you build that into your strategy, in your game plan and what you really want to do well, you know what? I'll tack on at the end of this, because let's say we want to build the $200,000 we're talking about for net passive. Okay, sweet. We'll build out the game plan for the $200,000 net passive. Once we've built that portfolio, which I say that very flippantly, that might take 5, 6, 7 years, right? If you're an absolute beast and you go really hard, maybe it's 3-4 years.
Yeah.
But it's probably going to be 5 to 7 years. But at the end of that thing, we might tack on, okay, sweet. How do we actually then get to a net position of, say, $3, $4, maybe $5 million liquid? Let's even say it was $2.5 million liquid. How do we get to that position at the end of building the 200,000 net, where we could bank out a $2.5, $3 million liquid profit and then go buy the primary residence with $2.5, $3 million cash, and then take on a significantly lower debt level and smash that debt level down, or keep having bread and butters to keep paying it down. You know what I mean? So like, that's a strategy, man. And I look at what I want now, and the thing I realized was I almost bought a house a few years ago for circa $5 million, right? The issue is, man, when you're going through this phase in your life and you're investing hard and you're working your ass off and you're going through and you're building all these things, man, your actual desires change. You know what I mean? So like, what you found really nice 2, 3, 5 years ago when you were making X amount or your portfolio was this size, as your portfolio starts growing, so does your goals and your ambitions and your expectations. So if you were to go and buy that $2.5 million property now, chances are by the time you've built $200,000 net passive, you've done all the other stuff. If you probably can't get there for one, because the debt's going to kill you. 100%. You're not going to get there, right? It's going to kill your borrowing capacity. So instead, man, if you went down the avenue of building out the portfolio first, focusing on that, being strategic, all the rest of the stuff to actually build that portfolio out, and then pivoted towards that as a back end play. For one, you'd get there because you wouldn't have killed your serviceability. But for two, what would undoubtedly happen is you will outgrow those dreams of that $2.5 million home. And you'd be like, hang on a second. Because in the GC, $2.5 million home does not get you on the canals. So you're maybe in a nicer suburb, but you're not in the canals, and you're probably in an okay house, right? Which might have been the dream, like when you first started, because you might have thought that there was way too far out of the picture. But now all of a sudden, I've got a few $1 million portfolio owned, almost debt free, producing $200,000 a year net passive. Well, man, I don't want that much coming in. I don't even need to work making that amount. My goals have now changed to a $4 million, $5 million, primary residence, man. And I've seen it happen literally in the last like 2, 3, 4 years of people's change in their minds. And I had it myself personally. And if I bought that house now, whilst it's nice, it's not my ultimate home, and so the ultimate home is a very different price point to that. And if I was to buy that right now, it would kill my borrowing of what I'm doing right now from a cash flow perspective, what I'm acquiring. So it's like, it just doesn't make sense, man. Rent for $2,000, $100,000 a year, live in a really, really nice place, but still I'm able to keep doing my thing from an investment perspective as well. So it's, Man, your primary residence is the biggest anchor you'll ever require if you buy it before the end of building a portfolio.
Which is like probably insane for a lot of Aussie ears.
Yes.
You know, it was only, you know, as I started talking to yourself, I think it was our last podcast together, that I really regretted doing that. Yeah, I really regretted going the traditional route because I mean it makes so much sense. Now, one thing that you and I were talking about last time we had our podcast, actually we were having a chat after the podcast, and I asked something. You know, I didn't put it on the air because it was a case of, you know, probably not fair to put you on the spot like that. But I was like, you know,
I'm curious where this is going.
I asked something like, you know, how expensive are you? Blah blah blah. And we're going down that route, and then you said something. Well, it's because not all of our team are BAs. We've got researchers, we have strategists, we have the BAs, we have this, we have that, to build that holistic kind of end-to-end experience to help people, and it kind of flicked. That was a flicker because market research. You have a team that's doing market research that is identifying those growth suburbs, which allows you to say, hand on heart, the house that I'm recommending you now, I'm putting my seal of guarantee on it. That according to our research, will do really well.
Yep.
Now, market research is really, really fundamental to achieving this, to achieving people's long-term strategies. Talk us through that and talk us through maybe your methodology with it as well.
Market research? Yeah, man. Look, I think the thing with market research, dude, there's so many different like tangibles to take into account when you are looking at an area, and before you pretty much pick an area and then go deep dive on it. And I think the biggest thing that we do, man, when all the market fundamentals that pretty much almost everyone sort of talks about, there's a few different things that we tweak and we really take into account. Key things being around like affordability metrics, repayment metrics, all these sorts of things, income to house price ratios, just different little things that are actually quite important to decision making for us as well. Man, then we go and get in the round.
So that would be like, so you might find a suburb where the yield's good, but if the affordability gap is too big and people's incomes don't really have much flexibility to pay, say, higher rents, you would maybe look at that and say, this might not be the best place to go.
It's always case by case, man. It always depends sort of what's coming into an area as well and what potentially could be driving it. So it depends if there's drivers coming into an area and not. You know, we'll depend a lot on how much weight we put on that as well, because we know when things are coming into an area, incomes will spike as well. So it's a very important, man, exactly, when you kind of use the word holistic before, it has to kind of be the same thing when it's location researching, because there's so much to take into account, and it's not just like, oh, well, this ticks 70% of our boxes, so it makes sense. Because if it's the wrong combination of 70%, it may not perform. So it's like, it's actually looking at like what different things definitely stack up that will make a market turn, or what's missing from that equation. Is it going to change? And if it isn't going to change, but you've got 70%, but you're missing a few key things, it's like having everything in a car.
Except the wheels.
Except a starter engine.
Yeah.
You know what I mean?
Yeah.
Literally, like something small, like literally something like that. And especially for something like a car. Yeah. You know what I mean? Like it's absolutely crucial, man. So it's like it may be these one or two missing little pieces that are absolutely crucial. And this is the thing, man. It's just there's so many different factors that layer on top of it. And I've been doing this so long now. Like, dude, I'm in my 16th year of investing.
No way.
Man, and like, it's funny because like I'm a farm boy, right? I'm originally like a farm boy. But when it comes to like money and property, I get so almost like addicted to figuring out how it works. So when it came to the property market in my early 20s, man, I became addicted to like really figuring out how all these things work. So a lot of people think I'm just like the reno guy or the cash flow guy or whatever. Dude, I'm so hyper focused on growth, man. I'd literally put myself against pretty much any researcher in the country and put our properties like for like against them. I'd probably outperform just about everyone, if not everyone. Yeah. That's how confident I am in it and how much we literally go through the actual application of it. And yeah, man, like when all those things stack up and we back ourselves fully on it, then man, then we're all in. And dude, I one of the other big things that I don't know anyone else that really does this, man, is we go get in the ground in every location, dude. We drive the streets, man. I just got back from like 3 weeks on the road, pretty much on and off on the road, like scouting locations, being here, there.
I saw your email bounce backs. You're out of office. Like, Sam Gordon's on the road, won't be back until.
Oh, dude, and like people are like, dude, is this legit? Because this is like 3 weeks away. Like you just got back and now it's like 3 weeks away. I'm like, yeah, man. Like,
that's a lot of driving.
Yeah, man, dude, it's heaps. And like I'll go with we go with the research team in different areas first, then we get on the ground with BAs in different areas too. And yeah, man, we get on the ground because there's so many, using that example before of like pockets within pockets as well. Like sometimes, man, it's not until you actually get there and you understand it. And sometimes it's literally a street and like, oh, this is a great pocket, except for that street. And do not buy in that street. Or if you buy in that street, just be aware that that street is like 50 to 100 grand less depending on the end of the street. You know what I mean? And like sometimes you don't know this stuff, man, until you get on there. And what we find is like, and this is where it can come down to city versus regional, right? In city, a lot of the time, they used to cluster a lot of housing commission, yeah? And so like you'd get these almost like ghettos in places, like you look at like Mount Druitt's and your places out in the east and then, and the west, sorry. And then you go to Brisbane, you might have you really hectic parts of Logan and all the rest of the sort of stuff as well. Whereas when it goes to regional, they may not have pockets like that. They may have streets. So instead of putting like all the houses in a specific pocket and having this really bad community there, they literally, a lot of them have layered the streets like all over the whole place. So you literally have to understand it from that level, man, because like, again, you get that buying wrong, you might overpay for something. And then for two, if you get that wrong, it may always carry a stigma that will always carry like a significant difference in price and not be able to sell it for good money or struggle to sell it just because that street has such a bad rep as well. So man, there's just so much to it that like we overlay on an area before we pick it. And man, hand on heart, we've actually had our books closed under 550 since November, mid-November. I'm not sure exactly when this potty's going out, but it's been about 3 months now since then. It was because we had this transitionary change with a few markets that we're in to where we're getting into the transition we're getting into now. And we didn't have the full tick. I hadn't given the full tick of approval on new locations, price points, pockets within it and everything as well, man. And like, we didn't want to burn someone by putting them, and we didn't want to burn our name from going into somewhere where we shouldn't have and didn't understand it properly. It's like that process might be like 3 months, especially with the Christmas period in there and not being able to actually get access to people as well. So
yeah.
Mate, there's just so much about it. It's not just like, oh yeah, well this suburb's going to be good, so I'll just find a deal in there. There's so many layers to it, man, to get it 100% right. From the location to the property itself, drilling all the way down to, the location, the pocket within the location, then drilling all the way down to the street and the house itself, man. There's so much to do with it to get it absolutely right.
So you're big in investing in the regions. You back it.
Both, man. You know what's really funny? I'm a country boy, and I never bought in the regions until about. I probably didn't buy my first regional property till about 2, maybe 3 years ago. Maybe 2022.
You don't consider Wollongong the regions?
No. Come on, man. What do you mean, man? No chance. No
it's
chance.
an hour out of Sydney. I don't know.
Come on, man. No. So man, mate, like if we're talking, like the Gold Coast is considered regional, but there's like 600,000 people there. Wollongong's considered regional. It's 500,000-600,000 people an hour from Sydney. Like it's still part of the metro basin. But yeah, man, I never went there because when the metros made so much sense, to me, I was like, well, if the metros make that much sense, I'll stay in a capital city of 1 mil, 2 mil plus sort of population and have that base and have that sort of anchor and security. But then when a lot of those were reaching their heights, obviously that's when we kind of broadened it a little bit more. And it was 2021, we probably started going further afield. 2022, we started properly regional. But dude, that for me was 13 years of my investing journey. I started
to take you up to that point.
Before I ever bought something. Actually, I bought a couple of unit blocks regionally, but never for clients. Like the unit blocks for myself, 2019, 2020, proper regional. But other than that, yeah, man, we hadn't. So I'm definitely a mix. It's where it makes the most sense, man. I don't.
Well, I think investors are always going to herd where they see the best returns. And, I think we've seen it with the data recently. It's pretty clear for the reasons that we said before. Your kind of upper quartile houses in metros, you're just not going to get good money on it. So you're going to go further afield, and investors will keep going further afield as well. I think, my internal compass is like the Harris Farm compass. See where Harris Farm's opening a new shop. That'll work.
Using the Harris Farm one.
Yeah.
Dude, it used to be like 10 years ago, it was Aldi. It was like following Aldi. Yeah, because Aldi, the ones like, because Aldi, man, like 10 years ago were like the up and comers, man. Now they're like the same as everywhere else where Coles and Woolies are.
You were using like an Aldi metric.
I wasn't, but it was a thing.
It was a thing.
So same as what you're saying about the Harris Farm, it was the Aldi metric because they obviously do the research.
Yeah,
and then if it makes sense to open the store and get in there. But it's funny you say about Harris Farm, yeah, man, because that's yeah, that was the Aldi of 10 years ago.
Yeah, 100%. Now, mate, conscious of our time, you're
Yes.
probably going to have to head soon. What's next on your to-do list? What do you have looking forward to you in 2025?
Mate, moving forward 2025, where, man, there's a lot of big things sort of cooking up with us. I've got something big coming up. That's end of the year, so we'll save that announcement for around that time. But that's
you can't be the kind of guy like,
it's not fully done yet.
Massive things, massive moves. Watch my Instagram, see more.
I don't know. I'm not one to normally say anything like that, but there is something pretty big cooking up, but it's not 100% finalized yet. So that's something that I'm working on in the background myself personally. But man, we're very excited about new locations, new areas that we're into. Man, with there's a lot that we've sort of unlocked and are just starting to unlock and open up now as well. So I'm really excited about those. I'll be getting on the ground a lot this year as well, which I'm really looking forward to with the other BAs and the team.
How does that work? So you partner up with local BAs and you go and
no. I train
your internal team.
Yeah, internal team. Yeah. So we train internally. Like we train our BAs for 12 months before they go out properly themselves. It's
12 months,
dude. It's like
it's
like an apprenticeship.
Yeah,
it's like a full apprenticeship, man. Yeah. It literally is because there's so much to get wrong with it. Yeah. There's so much to get right with it if you know.
How do they make you money over 12 months? If they're learning,
man. So the way that we structure our business is a little different from most, but it's suffice to say it's fine. Like
they can do
works.
Admin. I don't know.
Yeah, there's a lot of things they kind of do.
Yeah,
that's it. So it's kind of like an apprenticeship, right? Think of an apprenticeship. They still obviously put the work in and are super valuable to us. But yeah, man, it takes 12 months minimum effectively to graduate as a BA at APS. Yeah. And then man, like get on the ground with them, show them how I create relationships and help them with that as well. And man, it creates such a mad it's very strong from a relationship perspective that we like to focus on. And yeah, man, I've always been a big fan of doing it, and I love it. I love getting on the ground doing it, man. And the other, probably the biggest thing that we're working on this year, probably the most exciting thing that we're, obviously doing a lot of work around this year is the commercial arm. Yeah. So we obviously, it took me 12, 18 months to build that out. We launched that kind of in Q3, Q4 last year, and actually opening it to the public. We had it open, closed doors to clients, like internal clients and obviously internal staff as well, for probably around about 12 months now. Yeah. Yeah, man. And like I've absolutely loved kind of diving into that different thing, like even kind of like manufactured cash flow within it as well, which I always did in resi, but now we're doing in commercial, and building the same relationships that we always did from a residential perspective, and now building that in the commercial space as well. And it's a very different demographic and a very different style of person. A commercial agent is very different from a resi agent, and you got to learn to speak the lingo and understand it properly. But man, I like I was saying before, like anything that is dollars and cents and property and all the rest of it, and I love learning about it. So how
did you train yourself on the commercial side? Because it is very different. Like how did you go about?
Yeah, so I hired internally people that had a lot of experience and started working with them on it. And man, I learned from action. So I always learned from actually going through and doing things myself. So I've already got over 15 commercial properties in the portfolio now myself personally. So it's been a really good learning curve with that, man, doing different strategies within it. And then, man, just researching the hell out of it, like hitting our guys with questions. We got over 100 years of combined commercial real estate experience internally in the team now. And those guys just been getting smashed by me like nonstop.
Yeah, I can imagine. The 11 o'clock texts.
Man, 100% phone calls, brother. It's not text.
Phone calls.
I want this answer.
No.
Yeah, man. But it's like, it's all for the greater good, man. Like of both of themselves and obviously for APS and our clients as well. So I love it, and I've really, really engrossed myself in it in the last like 12 to 18 months. Because 18 months ago, I could see that resi cash flow was going to be compromised. There was just too much yield compression, so we had to obviously deviate and go towards the commercial route. I always knew it was coming. So I've been researching it for a long time. I always knew it was coming. But yeah, we obviously had to pivot out of it when we had that massive yield compression over the last 12 months of really strong growth. So
yeah, absolutely.
It's been cool, man. And I love it. I was looking forward to another big year.
Now, congratulations on everything, because it seems like it's a pretty busy time over at APS HQ.
Thank you, mate.
CEO and founder, is that what title do you go by?
Director.
Director,
I'm not like the founder. Like,
founder, chairman. I don't know. That's probably got legal repercussions. Director.
We'll just go director.
Mate, thank you so much for joining us on the podcast today.
Always a pleasure, Liam, mate. Thanks for having me.
That was Sam Gordon, Director of APS, in with a Smart Property Investment Show. And we'll be back at the same time in just a few days. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.